Please subscribe, like, and share. It really helps us out. And of course, if you have any questions, comment below and we will answer you as soon as we can. Welcome to this video in our series on A-level economics. Topics covered today are as follows. 2.6, Macroeconomic Objectives and Policies, Part 2. This will be a short case study of the Great Depression and the 2008-09 global financial crisis. If you haven't seen our previous videos, click on the card above.
Today we will be looking at the case studies around macroeconomic objectives and policies. Specifically, the Great Depression of the 1930s and the global financial crisis of 2008-09. Firstly, the Great Depression. In the 1930s, the world experienced a severe depression known as the Great Depression. In the UK, unemployment was over 15%, and in the US it was almost 25%. The areas most affected in the UK were the primary and manufacturing industries that relied on exports and so were impacted by the collapse of world trade. So, what were the causes of the Great Depression? The Great Depression was set off by the Wall Street crash of 1929 when there was a sharp fall in share prices on the New York Stock Exchange, but economists have different views in what they believed caused the depression. Firstly, it may have been caused by the loss of consumer and business confidence. This is because shareholders lost money in the crash, others became worried about what would happen, and firms cut back investment, which led to a downward spiral in aggregate demand. Moreover, it could have been caused by the U.S. banking system. Banks had lent too much during the 1920s, which had created an unsustainable boom, and the system was unable to deal with issues following the crash. The government allowed banks to fail after the crash, which decreased confidence further and reduced loans to businesses and consumers, causing a fall in aggregate demand. Protectionism may also have been another cause of the Great Depression. It reduced world trade, which decreased aggregate demand and lowered confidence. Firms involved in exports were no longer able to pay banks their loans, which caused bank failures in the USA. America introduced the Smoot-Hawley Tariff Act in 1930, which decreased imports to the USA. Countries that traded with America saw a reduction in exports, which decreased in aggregate demand in their countries. America also suffered from a fall in exports as other countries retaliated. The UK was also affected by its commitment to the gold standard, in which its currency was fixed to the value of gold and therefore fixed to other currencies. It left the gold standard in 1914 but rejoined in 1925 at the 1914 level and value, despite the fact the value of the pound had fallen. The rejoining of the gold standard meant the pound was appreciated rapidly and exports fell as they became more expensive. The UK went into the Great Depression with an overvalued exchange rate.
What were the policy responses in the UK? The UK government believed that balancing the government budget was key to recovery and that borrowing money would prevent the private sector from doing so. They introduced an emergency budget that cut public sector wages and unemployment benefits by 10% and raised income tax from 22.5% to 25%. This reduced aggregate demand at a time when it needed to be increased. The pound came under attack from speculators and needed to be defended to prevent the UK from being forced out of the gold standard. A balanced budget meant the UK didn't have to borrow from abroad, which helped the exchange rate, as did the high interest rates used to defend the high exchange rate. However, the high interest rates also decreased demand. The UK was forced to leave the gold standard on 21st of September 1931 due to continued speculation against it. This caused the value of the pound to fall by 25% compared to other currencies, and allowed the Bank of England to cut interest rates by 2.5%, both of which helped the increased aggregate demand by increasing exports or increasing consumption and investment. There was a recovery in London and the South East, but Wales, the North, and Scotland did not reach full employment until 1941. What were the policy responses in the USA? The US government originally had the same view over a balanced budget as the UK. However, Franklin Roosevelt was elected in 1932 with his New Deal, which promised public sector investment, work schemes for the unemployed, and fiscal stimulus. The USA reached full employment in 1943. 2 years after joining the war, the same as Britain. Roosevelt's New Deal is an example of Keynesian expansionary fiscal policy but can be argued it was not large enough to be successful, although it did have a large impact as the US unemployment figure was so high.
Next, the global financial crisis of 2008-09. There are many parallels between the Great Depression and the global financial crisis. Both were started in the US and spread throughout the world, and both had large, long-term effects on the economy. However, the global financial crisis was much less severe than the Great Depression. What were the causes of the global financial crisis? The 2008 crisis was started by issues in mortgage lending in the USA. In the early 2000s, relatively poor people were encouraged by the government and banks to take out mortgages to buy their own homes. This was an example of moral hazard, as the bank workers saw higher bonuses for selling more mortgages. They were given low interest rates on the loan for the first few years, but many were no longer able to continue paying, as their repayments had increased. Houses were repossessed, demand fell, and prices fell, meaning the value of the houses was now less than the mortgage of the house. This is known as negative equity. At the same time, banks had been grouping prime mortgages, these being people who were likely to pay back their loans, and subprime mortgages, these being those who weren't likely, and selling packages to other banks and investors as if they were all prime mortgages. The aim was to reduce risk, since it meant no bank was highly dependent on risky mortgages. However, it increased risk as many were now holding assets worth less than they had paid for them. It spread the effects of the housing crash and the unpaid loans. When this was revealed, there was a fall in confidence and banks stopped lending between each other, fearing that they would lose money if the other bank were to collapse. Similar events occurred in the UK, Ireland, Spain, and Portugal. Northern Rock Building Society was the first affected in the UK in 2007, with too many loans not being repaid, and savers beginning to withdraw their money. In 2008, Lehman Brothers, an investment bank, was allowed to fail. This caused panic as people believed bank after bank would be allowed to collapse, leading to losses for savers.
What were the policy responses in the UK and the USA? Both governments were forced to nationalize banks and building societies and guarantee savers their money in order to prevent the chaos of a collapsed banking system. For example, the British government bought Northern Rock and most of the Royal Bank of Scotland and Lloyds Bank. They used expansionary monetary policies with record low interest rates and quantitative easing. The Bank of England said the QE led to lower unemployment and higher growth than would otherwise have been the case. However, the USA government had a more expansionary fiscal policy, and this is perhaps why it recovered faster. In 2010, the UK prioritized reducing national debt over providing a fiscal stimulus, but the USA did not make this decision until 2013. Thank you for watching our video. Please like, subscribe and share. And comment below so we can clarify things for you.